All the top headlines that we're tracking this afternoon. But first up, let's take a look at the market. And as I mentioned, clearly turning out to be another good day. Of course, we've given up from the highest point of the day, but despite that, continue to trade with gains of nearly 30 odd points as we speak. And of course, we have fallen from that 24,500 mark as well. But in terms of individual sectors that are in focus, IT clearly is shining bright in trade today. Nifty IT index itself is up 2.5%. That index too has cooled off from the highest point of the day. But despite that, turning out to be a good day for IT stocks. We have LTI Mindtree, that stock is up 3.5%. Infosys, HCL Tech and Persistent Systems are also gaining in excess of 3% in today's trading session. But there have been several developments when it comes to the energy market. And to understand them in greater detail, we are now joined by Mr. Narendra Taneja, independent energy expert who is now joining us. Mr. Taneja, good afternoon. Ashesha this side, and thank you for taking your time out and joining us here on ET Now. And let's start with
Good
the
afternoon.
developments that came overnight. Saudi Aramco has cut August crude oil prices for Asia by about $11 per barrel. And this is a rare Asian discount that it has given only for the third time in the last 10 years. How do you read this development, and what does this mean for a country like India, which relies heavily on imported crude to meet its consumption requirements?
Well, any kind of discount is always a good news for us since we are a massive importer and the third largest actually in the world. However, what Aramco has done is, their tanks are full, their stores are full, even the tankers, chartered by them or belonging to them are all full. And at the same time, they want to basically go on the switch to the normal production mode, which means they need to get rid of basically, all these tanks which are overflowing, the storage tanks which are overflowing. I think so. This is actually a very temporary measure. I don't think that we should expect that this to last forever. This may be probably for 4 weeks or 6 weeks max, and targeted at big importers like India, China, and Korea and Japan mainly, but there are others too in our part of the world. So this is a very calculated move. Let's not forget that Aramco is a very smart and sophisticated player in this. And their look east policy, basically to focus more on the east, there's countries like India and China, is very important. So there is a strong messaging that, look, you guys have been in trouble the last 4 months. We are here with a kind of new approach. At the same time, to secure their market share. Look, OPEC is functionally dead. With UAE is out of OPEC, and now there's signals that that Kazakhstan and Iraq might also actually quit OPEC. In such a situation, now Saudi Aramco and Saudi Arabia in particular, they have to protect their market share too. And where do you go? You look at the biggest importers today, they are in our part of the world, in Asia. So it's basically messaging, refreshing bridges, and building new kind of relationship with markets like India, China, Korea, Japan, and others in our part of the world. So there is a mixed bag. However, this is temporary. We should not read too much into it.
Okay, this is temporary and we should not read too much into it. That's the word coming in. But Mr. Taneja, at least in the near term, do you believe that this marks a signal that perhaps we are getting into a more competitive phase when it comes to pricing of oil in the global market?
Well, yes and no. It all depends. There are two major shifts which happened. The post, Hormuz crisis, countries like India, we have more or less decided that we don't want to depend on any one geography or one region, let's say for the sake of discussion, the Middle East. So India has started diversifying. And in fact, when the war started, we had no option. But we have now discovered new kind of, exporters, kind of build bridges with them, with countries like the United States, Canada, Mexico, Guyana, Brazil, Angola. We have had good relations with many of these countries, but we have further strengthened. At the same time, as part of the energy security strategy is to diversify as much possible. Earlier, we used to import only from 7 or 8 countries mainly, but today we are importing from 43 different countries. My own sense is this will continue. And company like Aramco will have to compete now, offer us better discounts, offer us better credit terms, offer us better terms and conditions so that we continue to buy more oil from them. However, at the same time, as far as India is concerned, as part of the energy security doctrine, I think we are not going to depend only on any one market or one region, even if they offer a very attractive term, because the game has changed, after what happened to Strait of Hormuz and the closure of Hormuz. However, we will continue to see if Saudi Aramco continue to offer better terms and conditions, also offer to invest more in India in downstream or midstream or upstream, then I think it's going to be a different kind of relationship. It might be the beginning of a new era of relationship between India and Saudi Aramco, which is not a bad news.
Correctly, India has clearly diversified its sourcing base when it comes to crude oil prices, especially after the Strait of Hormuz incident that happened over the last few months. But do you think that now that Saudi Aramco is offering this kind of discount, other players will also be forced to give discounts? You did tell us that it is temporary, but at least in the short term, will other players have to give more discounts in order to maintain their market share?
I think probably maybe short-term basis, maybe over the next 4 or 5 months. But if, for instance, the MOU signed between the United States and Iran is turned into a kind of a long-term peace deal, then I think things are going to go back to normal. The only difference would be earlier OPEC dominated as far as the pricing issue was concerned, the pricing landscape of crude oil. And now that it will not be OPEC, it will be America. Now we'll look at the Western Hemisphere, which has emerged as more important in terms of the supply of oil to the global supply system. I think the US is going to dominate. The US has emerged as the biggest producer, as we all know, and they also emerge as the biggest, swing producer. That's a very important factor. At the same time, when it comes to the overall strategy, America is dominating the Western Hemisphere in terms of energy, which means that, the role America is going to play in terms of pricing is going to be more crucial. And what America wants oil at $60 per barrel because that works for their economy. What OPEC wants at $90 per barrel. So I think for us, if OPEC on the one side, Saudi Aramco on the one side, and America on the other, or America supports on the other, they basically get into some kind of fight on this issue. It's good news for us. We want any situation, any kind of tussle between them, the two blocks, lead to cheaper oil prices or better discount for us on a sustained basis. Very good for us. However, oil is globally benchmarked to come to this conclusion that, look, there's plenty of supply available. We don't need to worry. That will be wrong. There is plenty of supply. The demand is still there. Demand is only going to grow from countries like India and China and many others in our part of the world and Africa. Therefore, medium to long term, we should be prepared for higher oil prices, and we should really do not count too much on Russian discount or Saudi Aramco discount beyond a certain. Russia was offering attractive discounts until yesterday. That is gone now. It's not there. Aramco has offered this discount is maybe for 5 weeks, 6 weeks, 7 weeks. The moment their tanks are empty and the new oil flows into the tanks and their storages, I think game is going to change. So as far as oil is concerned, we should be prepared. Since we are an oil economy, heavily dependent on imports, so we should be prepared that oil prices in time to come may stabilize in the region of $75 per barrel. But long term, oil is not going to be cheap. We should be prepared accordingly. However, what is more important for us is not only the price, to make sure that oil is available if there is Hormuz 2 or Hormuz 3 or Hormuz 4, that we make sure the oil supply is maintained, because oil is crucial for our economy, unlike for many other countries. For us, the backbone of our economy is oil.
And Mr. Taneja, while we are talking about oil, let's also talk about oil prices, because they've corrected about 40% from the recent highs of $119 per barrel. You're telling us that oil is not likely to be cheap going forward. What's the fair value of Brent crude at this point in time? Is it fairly valued at $72 per barrel? And going forward, even over the medium to longer term, where do you think oil prices will stabilize?
Well, that's a good question. I think, what is happening, there's a lot of kind of verbal war going on between President Trump and Iran. President Trump only yesterday said, look, Iran conveyed to Iran that, look, you fall in line. Otherwise, we're going to, finish the job. This means basically we'll attack again, that's whenever these kind of statements come, oil prices start going up. Oil prices don't like these kind of fights. However, my own sense is America wants to exit the war and Iran wants to take the full advantage of it. So this means that this is going to continue for next 6, 7 months, maybe 1 year, maybe even more than 1 year. So oil will keep going up and down, up and down. So when its kind of sentiments are good, statements are good from American president, oil may touch even $60, $62 per barrel. However, the statements are hot from Iran or from the American side, oil may again go back to $75 per barrel. However, American elections are coming, and America is going to make sure that when the parliamentary election, Congress elections come, oil prices are maintained at the lowest possible level, which means till November, we don't think the oil is going to go to $80 per barrel or anything in that range. Oil, because America will try its level best to keep the oil prices low, and also that President Trump's party can win the election. However, I mean, medium term to long term, the next 6 months, I think if we go for, let's say, $75 per barrel, sometime oil may be $60 per barrel, sometimes $77 per barrel. But if we look at $75 over the next 6 months on a stable basis or average, I think that probably is what's going to happen. Unless there is a new geopolitical trigger, America picks a war on Cuba or something like that, or something goes wrong somewhere else. Oil is a geopolitical commodity. Oil is 90% politics.
Clearly, oil is 90% politics, but unfortunately, it is very crucial for a country like India, which relies heavily on imported crude oil. Mr. Taneja, thank you so much for taking your time out and joining us here on ET Now and sharing your thoughts on where the crude oil market is headed and the latest developments that have come in the energy market. But shifting focus back to equity markets then, and the accident of the day, and that has to be Trent. The stock is under severe pressure. The stock is now down 12.5% after missing street estimates for the first quarter updates. Revenue growth slowed down even as Zudio saw strong store additions in the first quarter. Brokerages, however, have maintained their stance, and Snehi is now joining us with more details on what brokerage houses have to say on Trent after their first quarter updates. Snehi?
Well, yes. So just to sum up the kind of performance we've seen in quarter one from Trent, revenue growth has slowed down. Zudio addition has been strong, but West Side Store addition has been weak. Now, with this context, on the back of this, we've got some brokerage reactions that have come out. First of all, let's talk about Motilal Oswal. They continue to maintain a buy rating on the stock, and in fact, they've gone ahead and hiked the target price to 3,785 from 3,500 earlier. Everybody else continues to maintain their rating as well as their target price. Maybe they're looking at what the actual earnings come out to be, and there has been no change in estimates so far. For UBS, they've maintained a buy rating with a target price at 3,633. For Macquarie, they maintain outperform with a target price of 3,600 rupees per share. Bernstein, who we spoke to earlier in the day, they continue to maintain their outperform with rating with a target price of 3,500. Morgan Stanley maintains overweight with a target price of 3,151. And here's the rationale behind Morgan Stanley. They expect quarter one standalone EBITDA margin to improve 100 bips to 18.5% compared to 18.6% in quarter four. So flat on a sequential basis, some growth on a year-on-year basis, but they are also cautioning that the stock could see some weakness in the near term given the slightly weaker print. And we've also got views coming in from Citi, wherein they've maintained their sell rating with a target price of 1,822. So that's a very significant downside coming in from Citi. Lastly, we've also got views coming in from Goldman Sachs, wherein they continue to maintain their neutral stance on the stock with a target price of 2,886 rupees per share. They say that quarter one update was in line with their estimates, but they understand that it was slower than what the street was estimating, and marginal deterioration in trends from sales per sales store has been seen, contrary to what the expectation of was to see a rise on this front. They say that quarter four like-for-like growth will be in low single digits, could be same or in fact slower than what the previous quarter four performance was, but they maintain their FY27 sales growth estimates. More importantly, they are saying that their FY27 and FY28 growth estimates of 20.3% and 19.5% will only be maintained with a risk to a downside if the like-for-like growth does not recover to mid to high single digits in second half. So they are also watchful, but for now they have maintained their stance as well as target price.
Okay, Snehi, thanks so much for joining us. The stock clearly is tanking in trade today, 12.5% lower on the back of lower than expected updates that the company has reported for the first quarter. But shifting focus then, Jefferies says NSE's dominant market share position, diversified business model and strong cash generation sets it apart from its peers. The brokerage notes that NSE commands over 90% market share across most exchange segments, and the company is also expanding into commodities, potentially intensifying competition for others like MCX. Mithali is now joining us with highlights of this note and why BSE and MCX are both under pressure on the back of this Jefferies report. Mithali?
Right, so Jefferies is putting the spotlight on the NSE, and that is making up the heat on both MCX as well as BSE, as both these stocks trade under pressure in today's trading session. Now, the brokerage says that NSE stands out for its scale, diversification, as well as the dominant market position, commanding over 90% of the share across most exchange categories and nearly 70% of India's exchange industry revenues. The biggest structural story, if you see, is India's shift toward the options-driven market. The equity option turnover has grown at a staggering 56% CAGR between FY20 to FY26, and derivatives now contributing nearly 70% of NSE's operating revenues. But NSE, it is not just a derivative story. If you see, its presence spans across the cash equities, futures, bonds, currencies, commodities, clearing, technology, as well as the data services, giving it much broader revenue base as if you see in comparison to its listed peer. The exchange also boasts a strong balance sheet, limited capex requirements, as well as the robust cash generation capabilities, supporting the high dividend payouts. And with NSE expanding now its commodities business, the competitive pressure is also going to lie for MCX ahead. But the key takeaway from all of this, the brokerage note that has come out, is that NSE's eventual listing could reshape at how the investors value India's exchange space and force a reassessment on the premium valuations that currently BSE as well as MCX are enjoying.
Mitali, thanks so much for joining us with all those details. So that's a note coming in from Jefferies, and both MCX and BSE under pressure on the back of that. But on that note, we need to slip into a very short break. More news and updates will continue on the other side.